Hello and welcome. I'm Alex Halliday. Just the other day, the Intergovernmental Panel on Climate Change, the IPCC, issued the most comprehensive overview to date of the ways the planet is changing, reporting that global average temperatures are estimated to rise 1.5 degrees Celsius, that's 2.7 degrees Fahrenheit, above pre-industrial levels sometime around the first half of the 2030s. As humans continue to burn coal, oil, and natural gas, there are other components to the climate crisis as well, and other sources of emissions. But this is a critical threshold for global warming. The report, yet again, underscores the fact that nations need to make an immediate and drastic shift away from fossil fuels to prevent the planet from overheating dangerously beyond that level. So tonight we're going to take a deep dive into one aspect of the actions that have already begun to make a measurable difference, and the actions that are possible and necessary right now. Among those actions are investment strategies and finance. Specifically, we're going to be talking about putting money where the most powerful solutions are. The goal of decarbonizing our society is necessary and urgent. It will demand ingenuity, but also investment. The tools needed to decarbonize the global economy exist, and that's another very clear finding in the report that gets emphasized is we can do this, but mobilizing this at scale is a major challenge. So this evening, I'm going to be joined by two world-leading experts in the rapidly growing field of climate finance and investments policy. Caroline Flammer, who's Professor of International and Public Affairs and of Climate at Columbia University, researches how and under what conditions firms can enhance their competitiveness and their long-term profitability while strengthening instead of undermining the very system in which they operate, and hereby play a critical role in addressing climate change. At the same time, you can address issues like inequality, global health, and other grand challenges related to society and the natural environment. The Web of Science ranks Caroline amongst the top 100 highly cited researchers in the economics and business profession in terms of impact over the past 10 years. Among other roles, Caroline serves as the chair of the Academic Advisory Committee of the United Nations Principles for Responsible Investment, the largest network of responsible investors to date. And Bruce Usher is Professor of Professional Practice and the Elizabeth B. Strickler 86 and Mark T. Glogli 86 Faculty Director of the Tamer Center for Social Enterprise at Columbia Business School. Professor Usher teaches on the intersection of finance, social and environmental issues, and is a recipient of the Singby Prize for Scholarship in the Classroom, the Lear Award, and the Dean's Award for Teaching Excellence. Bruce Usher is also a member of the Columbia Climate School faculty and on the Executive Committee of the Earth Institute. He chairs Columbia University's Advisory Committee on Socially Responsible Investing. And in 2016, he established the Columbia University Scholarship for Displaced Students, providing an opportunity for refugees from anywhere in the world to complete their higher education. In 2019, Professor Usher published his first book, Renewable Energy, a Primer for the 21st Century, published by the Climate School and Columbia University. His latest book, Investing in the Era of Climate Change, was just published in the fall. I've got a copy here if you want to take it from me and borrow it. So fantastic book, wonderful illustrations, and gets you straight into the subject. I recommend you all have a go and get one right away. So I want to start off by asking both of our panelists tonight if they'd switch on their cameras and switch on their videos, switch on their sound. I'd like to ask how you both got into the field of that you're actually working in. So Caroline, do you want to kick off with how you got into the subject of green investment?
Sure. Let me not go back 2 centuries, but rather kind of, more directly. A couple of questions that I asked myself in the beginning or a key question for the real economy is, to what extent and how do companies' social and environmental responsible practices help improve their competitiveness? Correct? So if the purpose of a company is to achieve and sustain their competitiveness, to increase firm value, to what extent do these practices actually help improve their competitiveness? And so what I found in my research is yes, companies' social, environmental, and responsible practices can help improve their competitiveness by, for example, improving their innovativeness, help improve the employee governance. I mean, surprise, surprise, if you treat your employees well, it might help you attract, motivate, and retain the most talented employees, correct? We are all surprised about those findings. It can also help improve the competitiveness of companies on the product market and on the market for public, government procurement contracts. And it can sustain their competitiveness during times of economic crisis. And so perhaps not surprisingly, as a result, companies' social and environmental responsible practices can not only positively affect shareholders' perceptions, but also shareholders' returns. And so the bottom line is, companies' social and environmental responsible practices can, not always, of course not always, I mean, what does always improve the competitiveness, but it can, on average, improve the competitiveness and increase firm value. And so this led me to the question of, wait a minute, if it actually can be beneficial to companies, why don't we consider companies' social and environmental responsible practices as core to their business, as core to their strategy, as core to their corporate governance? And so this led me to look into corporate governance. One potential reason is, and this might have to do with my Swiss background, that I deeply care about the time dimension here, but the lack of long-term orientation, correct? So what is quite interesting is when you look at management theories, there's quite a shocking absence of the dimension of time. And so that also means, so for example, from a large literature in psychology and economics, we know that individuals in general, not just managers, but individuals are so-called hyperbolic discounters. So that means we all, on average, prefer short-term rewards over long-term rewards, even if long-term rewards are substantially higher. So that means in myopic, then if you add this to managers who are concerned about their careers, correct, who might get fired if they don't perform in the short term, and they might be incentivized with short-term incentives, that this myopic behavior is even further reinforced for managers. So that means in absence of longer-term incentives, or in absence of private incentives to care about social environmental dimensions, they may not engage in these activities, which tend to be more longer term. And so this basically then led me to corporate governance and to sustainable investing. And I'm going to stop here because I do think we only have 1 hour time.
Great. And we haven't got time to go to Switzerland. Anyway, but Bruce, let me thank you very much. That was really interesting, Caroline. Thank you. Bruce, prior to joining Columbia, you actually were CEO of Eco Securities Group PLC, which developed greenhouse gas emission reduction projects in developing countries. So why this sounds awfully useful. How did you come to this area of finance and investment? And what made you come to Columbia for that matter?
Well, the short answer is, Alex, entirely by accident, in the sense that I was not an environmentalist. I didn't have any background knowledge around climate change. I worked in finance, in investment banking and trading, first in Tokyo and then in New York, worked on Wall Street, so to put it. But in 2002, I became CEO of a climate finance company, the one you mentioned, Eco Securities, and we invested in greenhouse gas emission projects all over the world. And it's a long story, but it was simply by accident. I ended up in that role through a number of roles I'd taken leading smaller companies in the finance sector. And when I led Eco Securities, I had a couple of epiphanies, or came as quite a surprise to me at the time. I mean, now I look back, it seems so obvious. The first epiphany is that climate change is 2 words, and that second word is change. And not to oversimplify it, but tackling climate change is resulting in dramatic changes in how we invest capital, where we invest, and the opportunities that go with that. And as an investor, change is what creates opportunity. Change is what allows one to invest in new and exciting areas. So the first thing I found is that there are many very attractive risk-adjusted returns that come in decarbonizing and addressing climate change. And the second thing I learned, and this back to what Caroline said a few minutes ago, when a company has a sense of mission and purpose, you can attract incredible employees. Really, some of the world's best employees came to work for my company, Series. And I realized the intellectual challenge of addressing climate change and the importance of having a sense of mission and purpose for the company, in addition to trying to maximize the value of the company, was very successful. And as a result, I've been working in the sector ever since. And I only became an academic after Securities was acquired in 2009. And I've been in academia ever since.
Can I just ask, Bruce, sticking with you a little bit? That's really helpful. Thank you. And from your perspective, considering current and emerging technologies, policies, investment trends, etc., do you think we are on a path to avoiding catastrophic climate change?
No, but we can be. And this is the important thing.
So what are the most promising technologies that we need to scale up?
So we need to decarbonize global economy, because climate scientists, many of whom are at Columbia University, and we're few, Alex, right? They're pretty clear what we need to do. We need to decarbonize. We need to reduce emissions, global greenhouse gas emissions to zero, net zero, within about 30 years, right? So how do you do that? We need the technologies, which you asked me about, and we need capital to implement, scale those technologies. What are the most promising ones? I put those in two buckets. The first category, I would say, are technologies that are commercially competitive today with polluting incumbents, okay? Mostly fossil fuels. And what's in that bucket today: renewable energy, wind and solar. It's cheapest form of power generation in many parts of the world today and getting cheaper every year. And electric vehicles. Not yet cheapest, but preferred by customers because it's a better product for anybody who's driven an EV. They recognize that. So these cost competitive products, these preferred products, they're at scale. Those industries over $100 billion a year in investment. And this is the key part, Alex. If we implement renewable energy and electric vehicles globally, if we replace what currently uses fossil fuels, that reduces greenhouse gas emissions by about 50%. That gets us about halfway to net zero. So that's our starting point. And those technologies are obviously incredibly important to addressing climate change. The second bucket of technologies are technologies that are not yet commercially competitive with incumbent technologies. They're not yet at scale. Two big categories I put in there is green hydrogen and direct air capture. They're extremely exciting potential around these technologies to decarbonize, but for green hydrogen, cost seems to decline about 3 to 5x, and for direct air capture, probably about 10x in the climate costs in order to be competitive. But those technologies have a lot of early stage investments, a lot of venture capital is going into those areas, and we see costs coming down. So that second bucket is sort of where the innovation is happening. And there's one set of technology that's sort of put in the middle of the two buckets. It's moving from the not yet competitive to the competitive, and that's energy storage, essentially lithium-ion batteries, which are increasingly competitive as energy storage medium.
Great. Okay, that's very helpful. So let's sort of pivot slightly towards finance and investment in particular. And what's the role of investment? Asking both of you this really. What do you see as the role of investment in decarbonizing the economy? Caroline, do you want to go first?
What's the role in investment? A large one. So I would say, in addition to the potential role investors can play is large, correct? So in a sense, let me take a step back maybe. And, very often when it comes to climate change, but any other societal issues, such as biodiversity loss, social inequality, poverty, etc., correct? Very often we think, or the first reaction is, it's the government's responsibility to take actions and to regulate. I agree. And theoretically speaking, it would be the most efficient and effective way to tackle these grand societal challenges. But unfortunately, whatever the governments are doing, and I'm using my diplomatic skills here, it's not sufficient. It's just not sufficient. And that puts the spotlight on the private sector. What can the private sector do, and to what extent, to help mitigate these grand societal challenges, including climate change? Now, when it comes to investors, Bruce mentioned important channel, private capital investments in clean tech, correct? Now, there's the public capital market. And I would say there are different roles that investors can play. On one hand, first of all, improve their own environmental footprint, their own ESG practices, so to speak. Another aspect is while there is a lot of pressure on investors to divest from fossil fuel industries and other emission-intensive operations, if you really care about tackling climate change, divestment may not be the most effective way, because all you do is you divest, you clean up your portfolio, but basically nothing changes with respect to climate change, because all you do is clean up your portfolio and you shift those companies away, correct, from your own investments. But you do not change the underlying business practices of those portfolio companies you just divested from. Some other investors are going to pick them up and potentially the situation worsens. So what is important in order to ensure a transition to a low carbon economy, and I may want to add, to ensure a just transition that not only allows us to transition to a low carbon economy, but also without worsening social inequalities within countries and across countries, it's important that we engage, or investors engage actively with their portfolio companies and make sure they improve their sustainable business practices. In addition, there is debt, correct? Investing in debt. So investors can invest in, for example, green bonds, sustainability-linked bonds, etc. I would recommend to invest in certified ones, because one caveat is, or one challenge is that there's a lack of public governance. And so what has kicked in, and so that means a lack of public governance means there is an enormous concern about greenwashing, that the proceeds of those green bonds and related ESG fixed income instruments are indeed invested into, let's say, the development of green technology. So investors can invest in certified green bonds that help ensure that indeed the proceeds are invested in these clean tech. In addition, you can see investors can play an important role here. In addition, I would say go beyond just portfolio and equity and debt investments. Investors can engage with policymakers to try to trigger systemic change. There are numerous coalitions that have been formed that try to engage with policymakers that, again, at the end of the day, regulation would be the most effective way, correct? And so that can be an important role that investors can play to actually engage with the policymakers and regulators to trigger the systemic change that we really need. And in other words, so for example, if you look at the Principle of Responsible Investing Network, the largest network of responsible investors, they encourage their signatories to not only invest, actively engage, but also to actively engage in public policy. And so doing so will likely not only help make the environment and economic system more resilient, but also decrease the overall systemic risk. And I'm going to stop here.
Okay. So Bruce, let's ask you the same question.
So I'm going to come at it from a slightly different angle. And then,
okay.
Caroline said, the optimal solution here would be the government would finance it, since for political reasons, in many cases, the government's not. We're in the private sector. I actually see it differently. I think the optimal solution is the private sector invest. And the reason for that is we need investment in two forms. We need investment in innovation for those technologies I mentioned a minute ago, like green hydrogen, direct air capture. And we need investment in scaling the technologies that already are commercial. And in my experience, private capital, commercial capital, is really good at innovation and really good at scale. In other words, venture capitalists and other early stage investors really understand how to place capital to maximize the potential for that technology to become commercially viable. And once they are commercially viable, like say renewable energy, you need to scale it. You need to roll it out as quickly as possible. And again, businesses are very good at scale. That doesn't mean government has a critical role here. The private sector is not going to decarbonize on its own. The role of government is, of course, to provide those early subsidies to trigger that private sector investment, and also to smooth the path for innovation and scale. For example, regulatory requirements that make it easier to put that capital to work. But at the end of the day, I think I'd want to see the private sector being the one that's actually channeling the capital. And perhaps by default, that is in fact the system we have today.
Okay, so that's really interesting. So maybe I could get back to you a bit, Caroline, on the detail now of this. So for example, what do you see as the, you said a bit about how investors can influence very positively what's happening in their companies. But how do you actually, what do you see as the key challenges facing climate finance and perhaps sustainable finance more generally?
Good question. I would say one key challenge is that our thinking, our frameworks, our models, our practices are confined to the portfolio level and to the firm level. So what do I mean by that? You know, for example, there's a lot of conversation let me take a step back. In many, many countries around the world, there's a lack of mandatory disclosure requirements when it comes to ESG, correct, of non-financial information. That leads many companies not to disclose their practices.
Caroline, can you say what ESG are? Because I don't know who's listening to this thing. So
sure. Let me put it: environmental, social, and governance practices. Yeah. Some of them consider them only as the risk exposure of companies to environment, social, and governance aspects. Yeah. But very often the abbreviation is also used in terms of the environmental and social and governance practices of the companies or of the investors. Now, when you look at what is exciting to see, there is more and more activity around in this space, correct? But in a sense of our thinking, our frameworks, our models, our practices in this space is still confined to the portfolio level and firm level. Now, let me just give you a couple of examples to illustrate what I mean. So, for example, currently the SEC is debating about considering the mandatory disclosure of Scope 1, Scope 2 emissions, not necessarily Scope 3. So just to make sure that everybody's on the same page here, Scope 1 emissions are the direct emissions of a company. Scope 2, loosely speaking, are the emissions from the energy that they consume, and Scope 3 emissions are the emissions by the suppliers and by the customers. Now, if we were to mandate Scope 1 and Scope 2, but not necessarily Scope 3. First of all, it would be a major improvement compared to the status quo, because currently nothing is mandated, correct? So it would be major improvement. But the challenge is, if we do not include Scope 3, what likely happens, and that is already what we observe, is that companies start divesting their most emission-intensive operations, or they outsource them to some supplier. So Scope 1 becomes Scope 3. So on file, the way we currently assess the environmental performance of companies, it looks like they cleaned up their act. But nothing changes with respect to climate change, because all that is being done, they shipped their emissions to somebody else, correct? And so that is what I mean. Our thinking, our frameworks, our theories, our practices are currently confined to the firm level. Similar in terms of portfolio level, if you switch now to the investor side, when you look at the sustainable finance and the current practices, the most common way ESG investing is being practiced by the public capital market is passive ESG investing. That means they consider environmental and social factors in their portfolio construction, or they divest from bad players, but they don't engage. Correct? They don't engage, they don't change the business practices of the portfolio companies. It's just they clean up their own portfolio. This is what I mentioned before with the example before, correct? And so, and the last example I'm going to make is, for example, the way we currently capture the environmental practice is the focal firm's actions, as I mentioned. We do not capture to what extent companies lobby the government against climate policy. We don't capture the campaign contributions against climate policy, correct? And so to some extent, we don't have a holistic view of companies. And so this makes it very difficult for investors also to assess which are the good players and the bad players here. And so what we need is the development of better metrics that really capture the holistic actions of companies. We also need to adopt a systems-focused approach where we take into account the interrelationship between the climate change, biodiversity loss, and all other grand societal challenges, and their impact on business activity, their impact on, for example, the financial performance of the portfolio. This is what we currently don't do, neither in academia nor in practice.
Okay.
So there's potential for improvement to look at it from a different perspective.
Yeah, that's really interesting. Be very interesting to see how that gets played out. And of course, universities are thinking about, how to come up with strategies around investment and divestment that actually relate to performance. Of actually, Bruce Usher pioneered some of that stuff. So Bruce, maybe I should ask you something now. I was wondering, why is now the right time to invest in climate change solutions?
So as mentioned at the beginning of our talk, Alex introduced me. I entered the sector in 2002, just over 20 years ago. And in 2002, I think the science of climate change is already reasonably well understood, not nearly as academic or not nearly as focused or robust as today, but we understood pretty well what the problem was and the need to reduce emissions. The problem in 2002 was there really wasn't much to invest in. In other words, the solutions to decarbonize the global economy by and large didn't exist. Think about renewable energy. Solar was incredibly costly and tiny. Just to give you one data point, if you added up all the solar installed globally in 2002, it produced less power than one coal-fired facility, less than 1 gigawatt. Okay. And electric vehicles essentially didn't exist except a few golf carts and so on. So we understood the science, but we really couldn't invest back then, except in very small niche ways. And that's how initially where I was involved, we were investing hundreds of millions of dollars, which at the time seemed like a big number, but clearly was not making much of a dent. Fast forward to today, you ask, why is it time to invest now? Because there's a lot to invest in. Solar alone last year, over 200 gigawatts was financed and installed last year. It's 200 coal plants worth of power in 1 year, right? And every year that number gets bigger. Same for wind. Don't have to tell people what's going on electric vehicles. I think it's increasingly well understood and so on. And then there's dozens of technologies and sectors that are much more focused and less well known. So today we have an extraordinary number of climate solutions to invest in. Many of those solutions are commercially competitive. They're solutions, those are products they're selling to consumers. Many of those solutions have government support and financing. We also, more than 20 years ago, have social norms that are accelerating the acceptance of these products. So you see consumers, you see employees, they want to work for companies that are more sustainable. They want to buy products that are more sustainable. So you have all these drivers, most importantly, the innovation driver, but all of these drivers creating the opportunity to invest. And that just didn't exist even a decade ago. Today, it's a really, really different environment we're in.
So can I just follow up on that a little bit, Bruce? Because, I mean, if you remember the days of, small cassette recorders and little, there was a whole thing went on around different kinds of cassettes and who was going to win out in the technology, whether you're going to have an 8-track in your car or whatever. And the same thing with DVDs as to who's going to win that battle, And of course, nowadays it doesn't matter at all because we're all just downloading, streaming from the internet or whatever. But are there, when people are thinking about how to invest in in this major way, is there a slight fear that actually it's going to be redundant in 5 years' time? Or do you think that actually this range of options that's being developed with hydrogen, renewables, people talking about fuel cells, whatever it is, do you think that actually there is that range is actually healthy? Or do you think people are nervous about investing in stuff that might actually become redundant?
Well, I think the greatest challenge is not necessarily picking the technology. So in some cases, that's DVD versus the tape and the like. Some cases that's we're still a very early stage in those technologies, so you're in that area. But that's the role of venture capitalists. I mean, their job is to figure out which technology to know the future. The part that's hard, and actually in many ways the most interesting part as an investor, is not predicting trends. The trends are pretty clear. Fossil fuels are being replaced by renewable energy, and it's not me saying this. It's the International Energy Agency, IEA, which is represents does the analysis for the world's leading oil and gas companies. Oil and gas companies themselves, BP and others, are forecasting that renewables are replacing fossil fuels. Electric vehicles are replacing internal combustion engine. Every automobile company is changing their lineup because that trend is just so clear.
Yeah.
The hard part is figuring out not which technologies are going to win necessarily, but which companies are going to win. Or as I teach my students and write about my book, you're going to have winners and losers. And are you going to be the next, the next Tesla? Or are you going to be the next Kodak? Things didn't work out so well for Kodak. It was a winner at one time. And then
Yeah.
that's hard to predict. I mean, companies are very dynamic, or organizational change among incumbent companies is very, very hard for incumbents. Disruptive companies, on the other hand, sometimes find regulatory barriers to taking to being incumbents. The two case studies I think are the most interesting is the automobile sector, where Tesla did something that nobody thought was possible, which first successful American automobile company since World War II, and it's now obviously the most valuable automobile company in the world today. So that's a case of a disruptor disrupting the entire industry. But there's a case that's the other way around, which is in the solar sector. Few people realize the most successful company in renewable energy in America today is a company called NextEra. NextEra was a small utility in Florida called Florida Power and Light, an incumbent, a classic American incumbent company. And they've grown to become the most valuable utility in America, one of the most valuable utilities in the world at this point, by being on the forefront of renewables. So, you know, being able to say that the disruptor would succeed in one sector, automobiles, and an incumbent would succeed in other sector, the power sector. These are tough things for an investor to pick at. But that's a job of investing.
So what scale of investment do we need for the future in order for investment to make a real impact?
So to get to net zero, to get to net zero over 30 years, the estimates are somewhere between 100 trillion and 200 trillion. That sounds like a wide range, but it's a little hard to estimate simply because the cost of many technology is coming down very fast. So
you're talking in total, right?
In total. So it's total globally over 30 years, which, it's a big number, Alex, right? 100 trillion, 200 trillion, that's a big number. Break it down though, per year, that's about $3 to $6 trillion per year. Yeah. And given the size of the capital markets today, which are over 100 trillion, in fact, that capital exists. And today it's already in most places available. The one area where it's generally not available is in developing countries, particularly the really less developed countries are challenged to that. And that's because the long-term nature of these investments, there's real challenges around that. But certainly in Europe, the US, China, Japan, this capital already is available and being invested quite rapidly at this point.
It seems almost like, sorry, I'm following up on this, but it seems almost ironic that you would think, Africa has got so much potential for solar power, and actually becoming an incredible provider of energy. And yet there isn't more investment in it. That seems like almost logical.
It's a tragedy is what it is. And we haven't talked about, of course, the tragedy, the true injustice around climate change, which is sub-Saharan Africa and other countries that have, the least amount of pollution going to probably suffer the most. But when it comes to investment, the problem is unfortunately quite simple, which also means it's quite hard to solve, which is most climate solutions like renewables or electric vehicles are competitive. In other words, they can replace the polluting product over a long period of time. In other words, a solar project produces really cheap electricity if you run that solar project for 20 or 30 years. If you're willing to invest for 20 or 30 years, you've got a better project than investing in a coal or natural gas. It'll pay out over that period. But in countries where there's political instability, where foreign exchange rates are highly volatile, your cost of capital is very high. Your investment periods are relatively short, maybe only a couple of years at most. And so what is a very sensible investment, say in the US, is just not going to make financial sense in a country that has very high interest rates and instability. And there's no easy solution to that. Really, that's actually where we get back to Carolyn's point about government, specifically multilaterals like the World Bank. That is their job, that's their responsibility, and they're maybe just now starting to step up to that. I think they're way behind the curve in recognizing that and addressing it.
So I was going to ask Bruce you this, but actually I'd rather ask Caroline or get both of you to answer this. What pitfalls should investors be mindful of when investing in climate-friendly solutions? You must have both thought about this quite a lot. Caroline, what do you think are the major pitfalls that investors need to be aware of?
Pitfalls. I rather like to look at opportunities here.
Yeah, sorry.
If I may tweak your question a little bit here, in a sense of, I think, an untapped opportunity or it's not really untapped, but I think there's enormous potential we know too little about is blended finance. And Bruce mentioned it before, there's an enormous financing gap, correct? And there is an opportunity for private capital investments to come in, but especially in countries where there's a high risk, potentially, public funding or concessionary funding can play an important role in acting as a seed grant that helps subsidize, but also de-risk the investment of capital, private capital investors. And I think what we need to really better understand, but also where I feel there is much more potential, is in these public-private partnerships between financial institutions. So, for example, that development banks, etc., and NGOs that can provide technical assistance on one hand to help de-risk the project and provide as an ex-ante de-risking mechanism, for example, but then also as an insurance ex-post investment, that in case a project fails, the private capital investor is insured to some extent, which helps de-risk the investment, therefore make it more attractive for private capital investment to kick in. So I think we need to explore this much better and better understand it. It also means we need much more academic research in this space. I hand it over to Bruce to talk about the pitfalls.
The pitfalls. There's a lot of pitfalls in investing in climate solutions, and most of those pitfalls are the same as investing in anything else, right? Investing is a challenging business. But I think there's two, Alex, that are specific to this sector that I see over and over again. And the first is people get tripped up by short-term events, and they take their eye off the long term. Climate change is playing out. This is a 30-year sprint, and for those in the science, 30 years is an incredibly short period of time. But as an investor, it's a long time to stay focused and keep your eye on the ball. An example of that is what's happened with oil and gas prices in the past year. So, for a number of years, the renewable energy sector is outperforming fossil fuels. People invest in oil and gas companies did very poorly in their investments. And then last year, oil and gas prices spiked, and oil and gas companies made record profits, most money ever, and share prices went up dramatically. And you see investors suddenly saying, "Oh, obviously I'm investing in this sector. It's such a great sector," and so on. Well, why did oil and gas prices go up? Was it demand driven? No, it was the war. It is the war in Ukraine. It is an event. Hopefully, it is a short-term event, and it really has nothing to do with climate change. It's an absolute tragedy what is happening. But the long-term trend is very clear. The long-term trend is declining demand in oil and gas. And with declining demand will come declining margins and ultimately declining profits and share prices. So investors, I think, have a hard time sticking with that when you see this markets change, especially so dramatically in the past year. But we have to recognize that change is completely outside of the analysis. I don't think anybody saw the war in Ukraine coming in that sense as an investor. The other one I see a lot of, and Caroline mentioned this a few minutes ago, but I think it bears repeating, as investors, is the risk of greenwashing. So you see a lot of companies making promises and then not living up to those promises. As an investor, you could finance a company and then it turns out to do something different. That's not a good outcome for you as an investor. And a lot of this comes down to the issue that Caroline raised, which is all the reporting in this sector around the climate side is voluntary. Now that's starting to change. There's some changes in Europe. The SEC is looking at making changes here. But when you have companies entirely making voluntary reports, it's complete chaos out there. And even for companies, I think, that want to do the right thing, I believe that most business leaders, they're not intending to cheat, so to speak, but they're looking at their sector and they realize they have to make these big promises, otherwise they're not competitive. Frankly, they may not know how to decarbonize, they may not know how to reach those promises, but there's no penalty for doing so. And so as an investor, greenwashing is a big problem, both from the climate perspective, of course, but even from the investment perspective. It's not good to invest in the company that's greenwashing. That doesn't generally have a good outcome.
So we're going to move on to audience questions in a few minutes. Before I do that, I'm going to ask each of you for one take-home message for our audience. But before we get to that, while you think about that, I'll ask you, Bruce, first. I'm going to ask you, Caroline, right now, if you could tell us a little bit about what you're doing with the Sustainable Investing Research Initiative, that is a sort of climate school, but also SEPA in particular has been playing a leading role in it. Can you tell us what it's about and what you're doing in that space?
Sure, thanks so much. So I think we touched on a lot of points today, correct? There's on one hand, we need to develop better metrics that help us capture this systems-focused approach where we have the holistic, where we really capture the holistic performance of companies and investors in terms of what they are doing, not only from the focal firm's perspective, but also whether and to what extent they, let me take the role of the investor now, to what extent do they engage with their portfolio companies to improve their practices? Because we cannot just invest in clean tech. That's very, very important. But we also need to move the more emission-intensive companies to greener pastures, correct? So we need to move the whole economy and improve their practices. Another aspect is to capture what do companies do, to what extent do they engage in policy, with policymakers to trigger systemic change, to trigger, for example, mandatory disclosure requirements, to trigger these regulations that we need to really get us to a more sustainable world. So this is, one is about development of better metrics. Another aspect is to foster rigorous academic research. We need to change our theories, our frameworks, our practices. And to do this, we need to foster rigorous academic research that takes into account the systems-focused approach, correct? The impact of investors and businesses on climate change, on biodiversity loss, etc., but also vice versa. What are the implications of these grand societal challenges on the private sector? We are not there yet. And so this is one aim. Hopefully, eventually, that rigorous research gets published in top-tier journals and becomes academic knowledge that filters into education after 2 centuries. We're not going to wait that long, correct? We don't have the time. So that means also we develop curriculum around it, training of the current leaders in business policy and investment, that means executive education, as well as of the future leaders in investment policy and business, that means the current master students. And last but not least, the organization of convenings, bring together key stakeholders from policy, from investment, from business, from academia, to hopefully not only talk, but also take actions around climate change and other issues.
Fantastic.
And I'm most happy to chat more about it with anyone, just contact me.
Okay, fantastic, thank you. So Bruce, give us your take-home message. What one thing, if people were to walk away from this, what one thing would you really like them to remember from tonight?
So the one thing I'd like to say on that point, Alex, is that I believe is a great misperception about climate change today. Specifically, I believe that the sort of common discussion that's out there today is that we're failing to make progress. And to a certain extent, that's true, right? As you know, as much as anyone, global emissions continue to rise year after year, right? But an increasing number of companies, countries, excuse me, have already begun to decouple economic growth and emissions. You know, if I could ask the audience a question, I know the audience is going to ask us questions, but if I could ask the audience a question, I would ask them, when do you think US greenhouse gas emissions will peak and begin to decline? Well, it's a trick question, right? US emissions peaked in 2007. We're down significantly, despite a period of very strong economic growth since 2007. German emissions are 40% below their peak, and the German economy in that period has grown 40% in real terms. So they've dramatically decoupled. The UK has decoupled. Most developed countries today have already begun declining emissions and still have strong economic growth. The big question mark is China. And China, it looks like they're probably going to peak maybe in the next year or two. Okay, reaching peak emissions is not good enough, right? We can't just peak emissions. We have to get emissions down to zero, and that's a long ways to go in the next 30 years. But this popular narrative that seems to get more and more attention, that things are only getting worse, it's not helpful, because what's happening, Alex, is we're seeing, you know, increasing number of what we call climate defeatists.
Yeah.
And climate defeatists, you know, it's a self-fulfilling prophecy. If enough people are climate defeatists, we don't do anything. We don't do anything. And yeah, it's hopeless at that point, right?
Yeah.
Look, when I got in this sector 20 years ago, we know we had to do. We actually couldn't do it. There was no way to decarbonize the global economy without essentially destroying the global economy. Today, okay, we have the window is much tighter, and that's very, very hard for us to get through that window of 30 years. But you know, we have the solutions to decarbonize. We have the capital to decarbonize, and I think we need to recognize that, and then just get to work and implement those solutions, which is the hard work. So that's my message.
Bruce, that's fantastic. Fantastic final point.
Thank you.
Caroline, you get the final word. What one take-home message would you like our audience to?
No pressure on me, correct? I would say it's not a question about whose responsibility it is. It's everyone's. Everyone plays a role. We need all hands on deck. So let's take actions. We would love to engage you all. Engage with us.
So that's great. Thank you very much. Okay, so we're going to have some Q&A now from the audience. We've got a ton of questions, a lot of people listening into this. So and we're not going to be able to deal with all the questions, but here's the first one. Basically, someone's asked, as a small scale investor, how can I invest in climate solutions through my 401k IRA? There are quite a few ESG funds, but I can't always tell if they are making a difference or just shifting costs. I can choose a few public companies to invest in, which may do better. If better funds were available in 401k IRA, we may be able to scale real climate investments to more people. How can we do that? Caroline, why don't you kick off for them? Just we haven't got much time, so if you can make the answers short, that'd be great. And I'll try and shorten the questions.
I'm glad you're actually even asking the question. You know, pay attention to where your money is invested, engage with them, pressure the pension funds, etc., to engage in longer term solutions and to engage, again, I can't emphasize this enough, to be stewards, correct? To be stewards, not just to divest, but to actively engage with portfolio companies, to engage with policy, to trigger systemic change. Another aspect is to look at the compensation of CEOs. We talked a lot about short-termism, and to think about how are they incentivized? Does it, do the companies and the compensation schemes, do they foster a longer-term orientation? And I'll stop there.
Okay, thanks. So here's another quick question. I'm going to throw this at you, Bruce. Is nuclear power not considered in the cost competitive bucket with wind and solar? I can think of a few answers to that. What makes it not qualify? Are there strategies in place to make it more competitive as an energy source? And I'll leave it there. There's other things he raised or she raises.
Yeah. So it's actually a great question. The simple answer is just not cost competitive. It's not even close to cost competitive today. The only nuclear plant being built in the U.S. is down in Georgia, and it's pretty much close to bankrupting the utility, if not the entire state. It's so costly. Now, the caveat to the response is there's a new generation of nuclear in development. It's called SMR nuclear.
Which stands for
small modular reactors. Right. They're much smaller, and you can move them more. That's why they call them modular. In theory, and people have a lot more expertise about this than I do, tell me, in fact, they are much lower costs and they work. They are safer as well, though that's not the issue here. It's really a constant issue. The first SMR to be commercial is forecast for 2029. That's another 6 years from now. I think 6 years from now, solar and wind are going to be so ridiculously cheap at that point as a source of power that the hope that these SMRs have to compete is pretty low. But
you still have the issue. You have this issue of intermittency still, right?
You still do, but energy storage at that point will be extremely cheap as well. The cost, particularly of batteries, and the other forms of long storage, like green hydrogen, provides a form of long storage, and then you got vehicle to grid. There's a number of different solutions to storage. My guess is nuclear will still be a piece of the puzzle. Certainly, operating nuclear plants, they should keep operating. I think what was done in Germany and Japan to shut them down was probably not the right thing from a cost perspective, but
Mhm.
new build is it's just uncompetitive. It's too expensive.
Okay, so here's one for you, Caroline. Will the European ESG disclosure requirements help move things ahead in the US? Do you want to explain what the difference is?
So I think it's fair to say that the Europeans are leading the charge here in terms of sustainability disclosure, and basically have tighter regulations around disclosure. And so the question is, does that spill over to the US, correct? Even if the US does not tighten its regulation in terms of mandatory disclosure, would that have positive spillover? I call them positive spillovers on the practices in the US. There's a lot of debate. You would expect that, for example, for companies, regardless of the size of the company, it's expensive to follow different practices, correct? And so you would expect that, especially those US companies that also operate overseas, that maybe they just say, okay, we need to comply to the European regulation here, disclosure regulation. So let's just let's just do this across the board, and hopefully there would be a positive spillover. Now, if this is sufficient, that's a big question mark. And ideally, US regulation would also tighten in terms of mandatory disclosure requirements.
So here's another one for you, Caroline. How do you identify real solutions from greenwashing? So especially when greenwashing can give companies more added value. How would you expose?
It's a very good question. And so, for example, I looked at this in the context of green bonds, correct? So in the meantime, there's a variety of different ESG fixed income instruments that have popped up: green bonds, sustainability bonds, climate bonds, et cetera, you name it. And the big question is, if from a legal perspective, there's no difference between a green bond and a regular bond, why would a company issue a green bond? There is a concern about greenwashing. And so I think what is important, and this is what I mentioned, third-party certification becomes very important here, correct? Now, how do you distinguish this? One is certification can play an important role in signaling that indeed the proceeds will be invested in real impact here. Another aspect is to really look at, well, what actions are they actually taking? Or, many companies have made pledges, carbon pledges. Many governments have made, not carbon pledges, sorry, net zero pledges, I should say.
Yeah.
Many companies have also made those pledges. But then again, there's a risk that the CEOs that make those pledges, well, they benefit from the positive vibe here, correct? Of, yes, the company is moving towards greener pastures, but then check, what investments are they actually undertaking? Do they really invest the money into clean tech, into changing their business model? And unfortunately, there is a concern about greenwashing. Again, there is a tragedy of time horizon here, because these investments, many of these investments are longer term investments. So you only see the fruit of investing in green technology, for example, after a number of years. By that time, that CEO, that manager might no longer be at the company, correct? And so a key question is really time horizon. How can you lengthen the time horizon of top managers beyond the time that they might be at the company? Because the average tenure of a CEO is about 5 to 7 years. So, and this is where, for example, the corporate governance of companies becomes important. Thanks for the question. I do think it's really important to look at what actions are companies actually taking and what processes are being put in place, be it by the board of directors or by then as a result of good governance, what kind of processes are put in place in the company to facilitate that transition. Sorry, that was a long answer.
Okay, we're running out of time. Short answers now. So, but that was really interesting, Caroline, so thank you. So can you say a little bit about, Bruce, about what sort of market mechanisms, policies, and regulation could support innovation in areas which don't appear to provide immediate short-term payoffs? I mean, you talked about this, that you need long-term investment here. How do we deal with that? How does a country deal with that?
Well, first of all, it depends a little bit on the country, right? I think countries are starting to recognize that there's certain areas where they can be more competitive than others, and that's what they're focusing on. That makes a lot of sense.
Yeah.
I would say, So they're sort of leaning into your strengths. You know, a crazy example of that is in Saudi Arabia, leaning very heavily into green hydrogen. Why? Because their solar resource is so strong and they have the land to develop a lot of that. So that's a competitive advantage, believe it or not, for that country. So country first identifying what's their competitive advantage in these emerging technologies, and secondly, where are the bottlenecks? I would point specifically to the Inflation Reduction Act as an act where the government subsidies, first of all, are spread across a lot of technologies, very targeted into those technologies, and targeting technologies in a way that will take investors to go, wait a minute, with those subsidies, that we can make those technologies cost competitive today. The subsidies won't be there forever, but it's enough to get production going, get some scale, drive down costs, and start that virtuous cycle of what we call the learning curve, which they drive down costs and make competitive. And we don't have time to dig into the many pieces of the Inflation Reduction Act, but it's been, I think, it's extremely thoughtful piece of legislation that I think will be very impactful in the amount of innovation that comes out of this space.
So maybe I could just ask one other quick question here. Corporate governance is driven in large part by boards of directors. So they are in turn beholden to stockholders. This contributes to short-term policies to increase stock prices, rewarding executives with millions. How can you incorporate behavior change under these considerations? You may both have an answer on this, but Bruce, let's kick off with you and then Caroline.
So there are two answers, right? Carrots and sticks, right? Punish, force companies with, force companies to regulation, or encourage them with subsidies and then like. Here in the U.S., we've gone very much the carrots, right? The subsidies way, and it appears to be more effective in this field. I don't know a single CEO or board that wants to run a shrinking company, a shrinking industry. Everybody wants growth. Everybody wants to, expand into the growing sector, and that's what the carrots form. They say, look, here's an opportunity. We'll subsidize that if you go and grow in that sector. And that seems to be very effective at getting the attention of boards and CEOs. My bias is that's the way you do it.
Caroline, what do you think?
I'm not giving up on corporate governance yet here. So first, it's not the stock price that should optimize here, correct? But it's rather the firm value. So maximizing firm value that is basically intrinsically long-term. Now, when we think about corporate governance and aligning incentives, traditionally, we've always thought, and this is where most of the literature and insights are, variable pay versus fixed pay. And you're right that the current practices, most often the variable pay is short-term compensation, which worsens the problem in terms of focusing on the short term. So I totally agree with you there. Yet, here comes the solution. potential way. One is bringing the time dimension. So that variable pay, it does not need to be pegged to short-term financial performance. It can be linked to longer-term financial performance, such as restricted stock options, restricted stocks, long-term incentive plans, correct? That get paid out only in 5 to 10 years. Maybe the CEO is no longer there, but in a sense of shifts the time horizon and the incentive to actually take into consideration the longer term firm value. So this is again kind of linking to that tragedy of time horizons, the misalignment of time horizons between managers and the firm. The firm's time horizon is arguably indefinite, correct? Another way, you may want to consider tying compensation to environmental and social performance criteria, so-called ESG-linked compensation, that then, and ideally tied to longer-term constituencies such as the natural environment or local communities that are not for all industries, but for several industries, for example, oil and gas, for example, mining industry and transportation industry, where the natural environment and the local communities are very important stakeholders, but they might be less salient in the short term. So they are not going to knock down your door or walk out the company if they're unhappy, like employees and consumers. So managers might not pay attention to them unless they're incentivized, correct?
Okay, we got to wrap it up. So
email me and I'm happy to continue the conversation.
I know that's great. Wonderful to have both of you here. Thank you, Bruce and Caroline, for a wonderful evening. Great presentations, but also wonderful to just pick your brains and get these questions from the audience. Thank you to all of you who've been listening in, spending time with us this evening. Climate change requires new ways of thinking about the future. And that's what we're trying to do at the Columbia Climate School, because we've got this phenomenal body of amazing people here who are not just brilliant from the point of view of the incredible academics, researchers, and scholars, but also the students who are highly energized and keen to see things done about the future of the planet in which they're going to be living. So this is the work of the Columbia Climate School. We need your help with this. Tonight's conversation speaks to the urgency of our work, but also how it can lead to concrete action. And we need that kind of big thinking, positive thinking, and emerging trends that we've been hearing about in a very positive way tonight. So thank you very much. We need your support, so feel free to get in touch if you'd like to help in any way, and look forward to seeing you at the next event. Thank you very much. Bye-bye.